Very good morning, my dear students. So next week we are going to write revision exam. So regarding that, what are the revisions for our periodic assessment exam? So it is called the periodic assessment exam. The two chapters, the revision is going on. So one is analysis of financial statements, chapter number 4. Then chapter 5, accounting ratios. Okay. So the two important one. In a main exam, in a board exam, each consists of 4 marks. Okay, 4 marks and 4 marks, 8 marks. But here we are going to discuss 70 marks for our revision. So you can study very well, then you can practice very well according to the revisions. Okay, the patronage exam planning here is that, see, part A, 20 questions, each 1 mark, you will get 20 marks. Okay, that's what. Part B, 4 questions, each 3 mark, 12 marks. Then part C, 3 questions, 4 marks, 12 marks. Okay. Then part D, 3 questions, each 6 marks, 18 marks. So finally one 8 mark question. Totally 31 questions, you have to write all the 31 questions. The total marks is 70. So you should be on theory also very important. Okay. You have to study theory part also. Okay. The first one is the analysis of financial statements. As you know, it is the meaning of financial statement. What's the meaning of financial statement? What is significance of financial statements? Okay, analysis. How they are going to analysis? What is the objectives of analysis of financial statements? Then similarly the limitations also. Okay, these are the classification you have to read well. Okay, so that's why these are the coming under theory part. You have to study well. Okay, so under the tools, you know already there are totally 5 type of tools available. So one is comparative statement, then common size statement, then trend analysis, just only for the theory purpose, then ratio analysis, cash flow analysis. Okay. So here, what is the format of comparative statement? That is very important. Okay. As you know already, our balance sheet and income statement, the format is very important. Based upon that format, you have to prepare the comparative statement. Comparative is nothing but our previous year and current year. That's what your first year and second year. Okay. So you have to write the particulars. The particulars may be according to our income statement or in the balance sheet format. Okay. So this what here, first one is particulars, then first year, then second year for the comparison. It may be same company or different company. Then here the fourth column is absolute increase or decrease. Increase means you have to make it plus mark. Decrease means in the bracket. Okay. Finally, you have to calculate the percentage, whether it's increase or decrease. Okay. So how you are going to calculate percentage increase, you know very well, correct? So absolute increase or decrease divided by first year absolute figure, that is the base figure, okay, this one, into 100. So everything in the form of percentage, okay. That's what's the format of the comparative statement. So accordingly, you have to prepare the balance sheet items. You should know the balance sheet items. Once you are strong in your previous chapter financial statement, this is very easy, okay. Similarly, income statement, the format of income statement, okay. Similarly, common size format here. Here also particulars, year 1, year 2, then percentage of each year, like year 1, year 2. Okay, earlier the collective percentage of comparative, here a common size, individually you have to calculate, separate year, maybe the same company or different company, okay. That is a very important thing. Then the accounting ratios. So the year also you have to learn the meaning of accounting ratios. What is the objectives of accounting ratios? That is very important. Then the advantages and limitations of accounting ratio. Okay. This is the accounting ratios. We are going to discuss totally 15 formulas. The types of ratios or classification of ratios, you know, liquidity ratios and solvency ratios and activity ratios and probability ratios. Okay, these are the 4 ratios. Now we are going to discuss the at one glance for all 15 ratios, like a summaries of accounting ratios. It's really useful for you, I hope that. So based on this, you have to practice well for the next week revision test. Okay. Okay, now you are going to see summary of accounting ratios. The first one is, as you know very well, liquidity ratios. Okay, so under liquidity ratios, the first one is current ratio, correct? So current assets divided by current liabilities. So whatever numerator, denominator, how you keep the formula, that is very important. So current assets divided by current liabilities. So numerator, what is the numerator, what is the denominator? So that is naturally keep in your mind. Ratios is very easily you can remember. Okay. So what is expressed here? How you expressed? Expressed in the form of pure ratio. Okay. So what is significance? So significance nothing but so short-term financial soundness of the business. Okay. The higher ratio means better capacity to meet its current obligations. So what is the ideal current ratio? 2:1. If it is very high, it shows the idleness of funds. Okay. So you can easily meet the short-term financial soundness of the business. That is the idea here. Okay. That's a very important ratio. Current assets divided by current liability, current ratio. The second one is very well in the current ratio. Before that, you should know what is the items available in current assets. Okay. Should be keep in your mind. The current investments, inventories. Inventories nothing but excluding stores and loose tools. Then trade receivables. Net of provision for doubtful debts. So you have to deduct our doubtful provision for doubtful debts. That's what here trade receivables. Then cash and cash equivalents, short-term loans and advances, and other current assets. Okay. Similarly, what's the current liabilities here? Short-term borrowings, trade payables, other current liabilities, and short-term provisions. Here, when you say it is called current assets, assets which is realized within the year. Correct. That's why it is called current assets. Similarly, current liabilities you have to pay within the year. Okay. So that's why the current ratio is very important. Then going for second one, it may be liquid ratio or quick ratio or acid test ratio. Okay. So what is the formula here? Liquid assets or quick assets divided by current liabilities. Okay. So here how we expressed, here also we can express the pure ratio. So what is significance here? We are preparing this ratio. Fairly stringent measure of liquidity. Okay. So based on those current assets which are highly liquid, it can be converted into cash and cash equivalents very easily. Correct. So what is the ideal quick ratio? 1:1. So higher the quick ratio, so naturally better the short-term financial position. We can be able to keep the business. Okay. That's what here liquid ratio, or you can also call quick ratio or acid test ratio. Okay. Here, what is the meaning of quick assets? Nothing but here, as a current assets, you know already, the items available, you have to deduct inventories and prepaid expenses. Correct. That's what your quick assets. Current liabilities, you know already, again, short-term borrowings, trade payables, other current liabilities, and short-term provisions here. Okay. So once again, what is the meaning of quick assets? Current assets minus inventories minus prepaid expenses. Okay. Then the solvency ratio, the second one. Under that, debt to equity ratio. What is the formula for debt to equity ratio? Again, numerator, denominator. Correct. Numerator, debt divided by equity. Correct. That's why here, debt divided by equity. Nothing but shareholders' fund. Debt to equity ratio. Here, how again express here also pure ratio. So why you are preparing this debt to equity ratio? Again, assess the long-term financial position and soundness of enterprise. Okay. So we are in a repaying capacity to meet our day-to-day expenses. Similarly, simultaneously, you have to meet our long-term also, correct, based upon our equity. What is our debt? So lower the debt to equity ratio, naturally, higher the degree of production enjoyed by the lenders. Okay, they can keep their money. They are keeping on checking how you are doing the business. They are verifying your day-to-day activities and all your position of the company. Okay, that's what here debt to equity ratio very important. Then debt to equity ratio here, what's the meaning of debt? Once again, the meaning of debt here nothing but long-term borrowings. What is the long-term borrowings? Debentures, mortgage and public deposits, and long-term provisions. Provision for the long year. Similarly, shareholders fund. Correct. Equity nothing but shareholders fund. So what is the consist of that? Share capital. Its share capital may be equity share capital or preference share capital. Then reserves and surplus or non-current assets. Correct. Non-current assets here, tangible assets, intangible assets, then non-current investments, then long-term loans and advances, working capital, then non-current liabilities. Correct. So these are the coming under shareholders fund. So you should know what is the meaning of debt and equity. Nothing but shareholders. So you can easily do this debt to equity ratio. Okay. Then second one, total assets to debt ratio. Similarly, same manner here, numerator, denominator. So total assets divided by debt. Then here also expression is pure ratio. So what is significance here? Measure the safety margin available to lenders of long debts. Okay. So the safety is very important here. For your meeting our long debts based upon our debt, what is our assets? Correct. So measure the extent to which debt is being covered by assets. According to our assets, what is our debts? You can be able to repay the capacity. Correct. So here, what is the total assets here? Nothing but Non-current assets maybe consist of tangible and intangible. As you know already what is tangible, you can be able to touch and feel. Intangible cannot touch and feel, correct? So non-current investments, long-term loans and advances, then current assets. Similarly, what is the meaning of here? Debt, nothing but long-term borrowings, maybe debentures, mortgage, public deposits, and long-term provisions. Okay, that's what here, total assets to debt ratio, you should be keep in your mind. What's the meaning of total assets and what's the meaning of debt? Okay, then third one, proprietary ratio. It's a very important one. Shareholders fund or proprietors fund or equity divided by total assets. Here numerator is what? Denominator what? Simply here. Okay, numerator is our shareholders fund. You can also call proprietors fund or equity divided by total assets. Here the expression is fraction. Maybe 1/3, 1/4 like that. Okay, that's why the expression also very important. So what is the significance of your property ratio? The extent to which total assets have been financed by the proprietor. Okay, the higher the ratio, higher the safety margin for lenders and creditors. Okay, so the creditors can they will be very safe. Okay, so they can repay our money. That's what here they will verify your property ratio. Okay, here fourth one is interest coverage ratio. It's very important. So what is the interest coverage ratio here? Nothing but a profit before interest and tax divided by interest on long-term debt. Here what's the meaning of interest on long-term debt? See, any debt you borrowed by debenture like that, you have to pay the interest, correct? That interest you have to make it division here. Okay, that's why our profit before interest and tax and dividend also divided by interest on long-term debt. Here expression is times, number of times, let me 1 or 2 or 3 like that. Okay, so expression is number of times. Its significance shows how many times the interest charges are covered by the profits available to pay interest. Okay, so higher the ratio, more secure the lenders is in respect of payment of interest regularly. So they will verify whether the company paying the interest regularly. We are in a position to pay the interest. Based upon that only we can move for the long-term debt. Okay, then the profit before interest and tax. What is the meaning? Nothing but profit after tax. Again we want to add tax and interest. That's what you will get once again. Profit before interest and tax. Okay, then activity turnover ratio, our third one. For that, inventory turnover ratio, nothing but cost of revenue from operations or cost of goods sold divided by average inventory. Here also a numerator and denominator. Okay, so cost of goods sold, here average inventory. How you express here also number of times expression. How many times? 1, 2, 3 like that. Inventory turnover ratio. So here significance here measures how fast inventory is moving and generating sales. Here what is the inventory here? Our stock position. So quickly whatever the stock, nothing but our unsold item. You can easily ready to sell anytime. That's what. Moving, generating sales very quickly. It will measure the inventory turnover ratio. So higher the ratio, so naturally more efficient management of inventories and vice versa. So here what is the meaning of average inventory? Nothing but our opening inventory and closing inventory divided by 2, you will get average inventory. Okay. Then the second one, it's very important. The trade receivables turnover ratio. Here the formula is credit revenue from operations. Here what is the credit revenue? Nothing but our credit sales. So then only when a person become debtor, when you dealing on goods on credit, okay, so customer can pay later on. So collectively summary of all the customers, they can pay. That's what our debtors or trade receivables. Here trade receivables nothing but our debtors and bills receivable. Okay, here credit revenue from operations divided by average trade receivables. Okay, how express number of times. Here significance shows efficiency in the collection of amount due from trade receivables. So higher the ratio, better it is, since it indicates that debts are being collected more quickly. Correct. So are giving less credit period to our customers like 15 days or 30 days. Quickly will get our money easily. Okay. Now third one, trade payable turnover ratio, opposite of our trade receivables. Here net credit purchases, nothing but our credit purchases from our creditors. Okay, so any purchases on credit, later on we are going to pay. Okay, we are going to pay our creditors. That's what here net credit purchases divided by average trade payables. Okay, here also how they are going to express number of times. Correct. Okay, it shows the number of times the creditors are turned over in relation to purchases. Okay, how many times? Significance of the creditors. So high turnover ratio. it shows that what? Shorter payment period shows the availability of less credit or early payments. For example, we are giving they are giving the more credit or less credit. Okay, the less credit also you are in a position to pay our creditors. Okay, that's what the idea here. High turnover ratio or shorter payment period shows the availability of less credit or early payment. So you want to pay quickly. That's what every creditor will expect. Correct. That is the calculation part here. Trade payables turnover ratio. Then fourth one. It's very important one. Working capital turnover ratio. Here also revenue from operations divided by working capital. That is the formula. Here the expression also number of times. The significance here shows the number of times working capital has been employed in the process of carrying on business. Okay. Saying working capital means nothing but what? Our current assets minus current liabilities. That's what the main significance. Okay. How our capital employed in the process of carrying on the business to get our revenue from operations. So naturally higher the ratio, better the efficiency in the utilization of working capital. A working capital, current assets minus current liabilities. Okay. Then finally our profitability ratio is a very important one. So as you know, profitability ratio, the first one is gross profit ratio. So what is the gross profit ratio? Gross profit divided by revenue from operations into 100. Here everything expressed in percentage. All the probability ratio expressed on percentage. What is significance here? Indicates the relationship between gross profit and our net sales. Okay. So higher the ratio, naturally lower the cost of goods sold. Nothing but our cost of production. So we will get more sales, so our cost of production very less. Naturally we will get more profit. Okay, that's what a gross profit ratio indicates here. Okay. Here how to calculate gross profit? What is the meaning of gross profit here? So you can also say revenue from operations minus cost of revenue from operations. Well, that's what you will get gross profit easily. Here what is the meaning of cost of revenue from operations? Nothing but our opening inventory plus net purchases. Here what is the meaning of net purchases? Purchases minus purchase return. Then direct expenses you want to add. Then closing inventory. So whatever the inventory you have to exclude here, spare parts and tools. Correct. Then also you can calculate cost of material consumed plus purchase of stock in trade plus changes in inventories of, it may be finished goods or work in progress and stock in trade. That's what the changes here. What the changes means? Opening and closing of finished goods and work in progress and stock in trade. Okay, that's what here changing inventories are meaning. Then direct expenses. So that's what here cost of revenue from operations. You can calculate either way. According to the available information, you can substitute the formula. That's why you should be very careful to calculate cost of revenue from operations. Then the second one, net profit ratio. See, what is the meaning of net profit ratio? Nothing but net profit after tax divided by revenue from operations into 100. So here, as we discussed earlier, expression here percentage, correct? How to express here percentage? Significance here, it indicates overall efficiency of the business. That's what every businessman, they will mostly aim on more net profit, correct? So here the higher the net profit ratio, then naturally the business is better way. They are keeping the business better way, they maintain the consistency, correct? So net profit after tax, what's the meaning here? Nothing but gross profit. Then we want to add other income. Then we are going to deduct indirect expenses and tax. So you will get net profit after tax. Okay. Then the operating ratio. It's a very important ratio. So what is the meaning of operating ratio here? The cost of revenue from operations plus you want to add operating expenses divided by revenue from operations into 100. Okay, that's what here numerator, denominator. Accordingly, you can easily memorize. Here also expression percentage. Okay, our operating ratio expression then percentage. Then what is significance here? Assess the operational efficiency of the business. So we can assess the operation, whether how the business going on to meet operating our expenses. It may decline in the operating ratio is better. So less operating ratio because it means higher margin and thus more profit. Okay, that's what our cost of production very less. Naturally, we get more profit. That is the calculation here. Here, what is the meaning of operating expenses? That is very important. It may be employee benefit expenses and you can add depreciation and amortization and you can add other expenses are collectively called operating expenses. Okay, that's why here should be very keep in your mind. Once again, repetition of the our formula, operating ratio, cost of revenue from operations plus operating expenses divided by revenue from operations into 100. Okay. The fourth one, operating profit ratio. So the two ratio definitely have confusion. That's why we should be very careful to memorize the formula. Here, operating profit ratio. Earlier we discussed the operating ratio, correct? So here the word is profit. So naturally operating profit, that's what you numerator, divided by, here also revenue from operations. So base this is our sales into 100. Expression also here percentage. The significance here, naturally the again I will determine the operational efficiency of management. Okay, that is the significance here. Why you are preparing operating profit ratio here. Okay, here what is the meaning of operating profit? Nothing but net profit before tax. Then we want to add operating expenses minus non-operating income, or you can other formula, gross profit plus operating income minus operating expenses. Here, what is the meaning of operating expenses? Okay, definitely you should know this meaning, correct? So interest on long-term borrowings. That's what one of the non-operating expenses we want to debit, correct? In our profit and loss account. The loss on sale of fixed asset or non-current assets. That's what here non-operating expenses. Similarly, what's the meaning of non-operating income? The interest received on investments. Any investment, you get the interest. Then profit on sale of fixed asset. Here, see, as a loss on sale of fixed asset, according to non-operating expenses, here as a income, profit on sale of fixed asset or non-current asset. That's why here, what's the meaning of non-operating expenses and non-operating expense income? So nothing not through the business, correct? So it is not through the business, correct? That's why it is called non-operating. And non-operating expenses and non-operating income. Okay, then so finally the last formula for the profitability ratio, return on investment, or also called return on capital employed. Okay, the profit before interest, tax and dividend, that's our numerator, divided by capital employed into 100. Here the also expression is percentage. Significance here what? Assess the overall performance of the enterprise, correct? So whatever the money invested, whether business is going on smooth way, we get profit or not. So all the important assessment you will get it here. It measures how efficiently the resources entrusted into the business are used. Utilization of resources, everything here, calculation here. Okay. Here what's the meaning of capital employed? How you are going to calculate? You should be very careful here. It may be liabilities approach or assets approach. So both way you can calculate according to our given problem. Sometimes when they are giving for the liability side information like share capital, reserves and surplus, and long-term borrowings and long-term provisions, so you can work it out based upon liabilities approach. Suppose they will give you non-current assets like tangible and intangible assets, then non-current investments, then long-term loans and advances, then working capital, nothing but our current assets minus current liabilities. We can calculate based upon assets approach. That's why either it may be liabilities approach or assets approach. Here what you are going to do, better you can work out both way, liabilities approach and assets approach for learning purpose. Okay, in main exam, according to information only you can be able to do. Okay, here you are going to practice how to practice based upon liabilities approach and assets approach. That is very important. Okay, that's what you discussed profitability ratio here. So finally, I hope that you discussed upon the summary of the accounting ratios here for our next week revisions. So read carefully the questions always before attend the answer. Okay, so calculate your time, planning, everything. So accordingly, you please work out all your problems and worksheets. Okay, all the best for your revisions. Okay, thank you very much.